Yeah, they're very small.
But it's not, the trails on a life insurance aren't going to be comparable to the trails on a managed account.
No. And I think, again, was the policy designed correctly? Was it designed where there's an end result that we're trying to get? Was there a purpose to this? Is it going to protect your money? Is it going to provide some kind of tax-free income to you? I mean, these are all the things you have to look at. It's the design of the contract that's most important. And everyone can get into their little bickering wars about, this type and that type, but it's inconsequential, because your advisor should have a good, legitimate reason. This is what we're trying to accomplish here. We need to carve out a portion of your portfolio that's going to create guaranteed income at some point in time. Because how many times have you seen clients when they've sold, and we carve out, $50,000, $80,000, $100,000 of just guaranteed income, coming from their insurance contracts and their Social Security? How happy are they to have at least that?
They're thrilled.
Yeah. It's like, I don't have to worry about this part right here. This is guaranteed. Okay. And I still have plenty of money left over to invest in the markets or to invest in real estate and to do all these other things. But I did a responsible thing. I took a lump sum of money and I put it in a place where it's going to guarantee me a guaranteed income and potential tax-free income for the rest of my life. Tell me where that is not prudent to do for anyone. It's not. Yeah. So, commissions aside, I mean, I've never seen scenarios where we would not have made more money putting people in like a fee approach over a 20 or 30 year period than an insurance contract. Now we do both. We do both because I don't think we're pigeonholed into one strategy. I don't think that our philosophy is a little different, where, I mean, I've ran into some advisors where they're just like, it's all public securities, marketable securities, ETFs, mutual funds, and that's it.
Yep. That's all they do.
That's all they do. And and real estate and insurance-based contracts are just a pariah based upon what you're going to earn in the markets if you stay fully invested, buy and hold, and never sell. That's it. There's no risk management at all that's done with that. Okay. So I think we killed it on insurance-based contracts. Let's go to real estate. Yes. What are you doing there? So let's say we allocate 100,000 to some kind of a strategy where the person's going to take a lump sum, put into an insurance-based contract. And then what are you doing with the real estate?
Well, with the real estate, I mean, once again, it's going to be situational dependent, but you got a couple key options, I think. Mm-hmm. Number one is if you own any existing non-primary residence real estate, so any rental real estate, be it residential or commercial. Option one is pay down the debt on it, right, to increase cash flow.
Got it. Okay, so get rid of the debt. So whatever the rental income is, you're gonna create the ability to get the majority of that quicker.
Exactly. That's option one. Option two would be to put it into some sort of real estate fund, whether that's a publicly traded REIT or it's a private placement offering. Option three, of course, would be to go out and buy real estate that you own, whether that's an Airbnb, a residential rental, commercial rental, whatever, But that's option three, is to buy it yourself.
Yeah, but 100,000 is not going to get you anything.
I mean, 100,000 can get you. I mean, you can get $1 million property with that.
Okay, so you're saying it would just be the 100,000 is a down payment.
Yeah.
On the property, and you get a mortgage on the rest.
Yeah, you don't need to buy $100,000 property that's debt free. No, you can. That 100,000 is going to buy you a lot if it's your down payment.
Yeah, I mean, even 20, I would probably go 20% down. So that would basically be at least $500,000 property that you could get.
Yep. Still. half mil,
and, yeah, $500,000 property, which, they're out there, especially, properties that are in places that people want to travel to. And you could then, of course you have to, but okay, what's the risk of this?
You have to be a landlord.
It's going to take
or you
your
have
time.
to pay someone to be a landlord.
Yeah. It's going to take your time and attention away.
Plus interest rates are high right now.
And interest rates are high right now. So the cash flow's got to make sure that it's in excess of your down payment and that you're earning your cash on cash return. What are you looking at here? I'm probably looking at anywhere between 8 and 12% that you should be earning on your cash. So what we're talking about there is that if I invested $100,000 into a real estate project of some kind that I'm doing myself, that I would want to earn, at minimum 8 to 12% on the cash that I invested. That means that after all the expenses, taxes, insurance, management, and the debt service, what does the cash left over represent as a part of my amount that I invested?
Yep.
That's
going to be tough to get an 8 to 12% return right now. Very, 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 very tough.
Yeah. So this is where I would just say, well, maybe you shouldn't do it yourself then. Maybe you should just give it to an operator that would know what they're doing in that case. So I think that would be, pretty prudent at that point.